Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing AstraZeneca stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AstraZeneca is a British, Swedish pharmaceutical and biopharmaceutical company with headquarters in England. The company has a portfolio of products for major disease areas, including cancer, cardiovascular, gastrointestinal, infection, and inflammation. The company was founded in 1999 through the merger of the Swedish company Astra and the British company Zeneca Group. Since the merger, it has been among the world's largest pharmaceutical companies and has made numerous corporate acquisitions. It conducts its research and development in England, Sweden, and Maryland. Let's get started with the model. This is a large cap company, 135 billion market cap. They're trading at $51 a share, and they have 2.6 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company had lots of free cash flow every year. Their lowest was in 2019 at $500 million. Net income is the profit and loss on the income statement. It's revenue minus expenses. The company had its highest net income in 2017 at $3 billion. It's currently at $2.5 billion. Revenue is a sales for the company, and that's pretty steady, but it seems to be climbing. It was $22.5 billion in 2017, up to $26 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales for the company. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is gross profit, which is revenue minus cost of revenue. They had the highest gross profit in the trailing 12 months. Then below that is their operating expenses. Then below that is their operating income. And that doubled from 2019, so they're really improving their margins. $3.4 billion in trailing 12 months. The company has a lot of debt, so they have a pretty big interest payment on their debt, $1.2 billion. Then of course there's taxes. And then the bottom line of the income statement is their net income. That was $2.5 billion. It did peak in 2017 at $3 billion because they had a $641 million tax credit. I would focus on operating income when I look at the income statement, since operating income is directly related to their business. Below that, the numbers can get a little skewed. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that peaked in the trailing 12 months at $4.4 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. And operating cash flow minus CapEx gives you your free cash flow. And that was almost $2 billion, so they have lots of cash to work with. The company did issue a lot of stock in 2019, $3.5 billion. Sometimes profitable companies issue stock or issue debt to acquire another business or to take on an expensive project. In 2017, they issued $2 billion of debt but paid down $1.4 billion. So they increased their debt load $600 million in 2017. They increased it $1.5 billion in 2018. They decreased their debt $1 billion in 2019. But in the trailing 12 months, they increased their debt $3 billion. You generally don't want to see a company adding debt, but the way companies look at debt these days, it's cheap money because interest rates are so low. So as long as they can pay the interest payments, it's fine. Let's look at a capital structure. $14.6 billion of equity, $18 billion of debt. So they have 44% equity, 56% debt. And their net debt is $12 billion. That means they have about $6 billion of cash on their balance sheet. And their WACC is 4.15%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for, that's $238 billion. We discounted those numbers back to today using the weighted average cost of capital, we get a value of the company of $214 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of $81. They're trading at $51, so they're trading at a 37% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $92 a share, so they're saying the stock is really undervalued. You can see their future expected cash flows are a lot higher than the past. That's because I grew their cash flows more than expected based off of the company's estimates and based off of analysts' future projections. So the stock seems to be only going up the past 5 years. It did take a little dip, but it came right back up. It looked like it peaked in the high 50s, low 60s, but now it's sitting around $51 a share. This company pays a 2.7% dividend yield, and they pay 2 dividends a year, one in August, one in February. So if you sum up these $2 amounts, then divide by the stock price, that's how you get the dividend yield. And they pay out 148% of their net income and 191% of their free cash flow. That seems really high. I don't know if they can continue that. So it looks like they may be using some of their debt or equity financing to fund their dividend payments. This company has a really low beta, 0.21. So if the market went up 5% in a given time frame, this stock should go up 1%. And if the market went down 5%, this stock should go down 1%. The stock only went up 1% in the past 52 weeks, much worse than the S&P 500. The 52-week low was $36, the high was $65. The stock is trading below its 200-day moving average, but above its 50-day moving average. When the 200-day moving average crosses above the 50-day moving average, that's called the death cross. That's a bearish signal. This is a pretty liquid stock. 10 to 11 million shares are traded each day. And of the 2.6 billion shares outstanding, almost all are on float. And only 17% of the shares are held by institutions. And it has a really low short percentage, 1.28% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $33,500 today. If you did not reinvest the dividends, you'd have $27,200 today. If you invested $10,000 into this company 10 years ago, it looks like the longer you held, the better off you would have been because the stock price kept going up. Their biggest shareholder is Capital Research at 8.4%, then BlackRock at 8%, then Wellington, Vanguard, and the last is Investor AB. Let's look at the financial ratios. The average PE in the market's 11.1, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 54.2, so they're doing worse than the median and average. 54.2 means investors are paying $54 for $1 of earnings. Price to sales is stock price over sales per share. They're at 5.2, so they're between the median and average. Price to book is stock price over book value per share. They're at 9.3. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on a balance sheet. And they have $14.6 billion of equity, but negative $19 billion of tangible equity because they have over $32 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 2.6, so they can just cover their interest payments 2.6 times. ROE is net income over equity. They have a really good ROE at 17%. Current ratio is current assets over current liabilities. They can cover 90% of their current liabilities with their current assets. Their current assets are $6.2 billion of cash and $3.2 billion of inventory. So the company is not well capitalized. It probably will need more debt or equity to run their business over the next 12 months because it only had $1.9 billion of free cash flow, but negative $2.5 billion of working capital. Working capital is current assets minus current liabilities. Plus it has to pay over $7 billion of dividends. The best way to look at ratios is to compare them to similar companies. I've done videos of 12 companies in the same industry as AstraZeneca. And if AstraZeneca has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're much worse in PE ratio. They are a little better in price to sales. They're worse in price to book. They're a lot worse in current ratio because they're below 1. Average is 2. ROE is good, but they're a little lower than average. They're a little worse in debt. They are a big company, 135 billion market cap, but that is worse than average because this industry has some really big companies in it. And they do pay a higher dividend than average at 2.7%. So to summarize, I do have them trading at a 37% discount. They're such a big global company, and they provide products that are so needed in society, but I think they need to cut their dividend because it seems like they're spending more money than they're bringing in. But the good thing is they have positive free cash flow, and it looks like there's a good chance they're going to grow a lot more in the future. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.